Hey there, it is John Downs here. Welcome back to the channel. It is the weekly update for May 17th. And I have to tell you, even though I say this probably every time, it's been a wild last couple of weeks. You know, I would say there's always these points in time where there's not as much clarity in where we go next. There's a lot of what ifs. And the last couple of weeks, we wound up getting some of those what ifs answered, kind of. So I'm going to explain that in this video. We have a lot to get into today. I'm going to talk a little bit about interest rates, show you just basic housing data, give you some reflections of what I'm experiencing in the market specifically. But it is important to kind of understand market behavior, exactly what is going on with mortgage rates. Yes, they've been improving, not as much as maybe we would want them to just yet, but then I'll show you a way of thinking about mortgages specifically. If you're a real estate agent, I think you'll find this interesting to just get a glimpse of how rates trade, sort of the long trends that unfold over time and why. If you're a loan officer, you'll probably learn a couple things, and home buyers, people looking to either get into real estate to buy their first house or even possibly moving up, might give you things to look for, probably some optimism as far as where rates might go from here. And luckily, we're in the DC Metro area, DC Baltimore Metro, and I do believe that in the face of any economic stress that comes our way, which we're starting to see some signs of, part of the reasons why interest rates are improving, but I feel like we're still in that resilient space where we have an economy that is diverse enough, whether it be healthcare, the tech sector that's kind of building, obviously government. Of course, we have lots of defense and defense contractors, military. You put all that together in a market that is quite constrained from a housing stock and housing supply side, not a lot of new construction. Put all that stuff together, regardless of economic stress in the economy, I think locally, things should look actually pretty well for us, especially if interest rates continue correcting. So let's go ahead and dive on in. This week on Wednesday, we had some inflation reports that were basically as expected, but as expected was better than what the market was likely predicting, right? So if you were in this mindset of confusion where the Fed came out 2 weeks ago and said, hey, we're going to start really looking at data. And that's what's most important. We think inflation's moving in the right direction. We think things are going to be okay, but we have to just see what the data says for us to figure out what to do next. You're really trying to look at every data report to make a decision or a determination of where things are going to trade. So if the Fed's worried about inflation and the inflation readings came in kind of as expected, that's actually a positive. We had retail sales actually drop off. That actually was not as good. New York Fed manufacturing softer than expected. So definitely some reports. Jobless claims were kind of A lot of people think those are sort of cooked right now and not putting a tremendous amount of faith in those. We had some Fed speakers that were, again, more positive than negative on the future, being that the next move is going to be a cut, not an increase. Now, on the mortgage rate side, you know, this is actually from Mortgage News Daily. This chart represents sort of average rates from lenders where loan adjustments are minimal and likely a 0-point loan. Now, there's a lot of variables that go into mortgage rates these days, so it's a hard conversation to have when you're comparing national rates. As an example, the Freddie Mac report, they now said we're not even going to show points, we're not going to show characteristics of loan. We are truly just going to show you the average rate over the last week. But average rates could have a lot of points. Maybe 1 week we have a lot of first-time home buyers where their rates are better than, let's say, move-up buyers. So anyway, a lot of noise in the data, but this one is probably the best one that I have that really shows direction and movement short-term over time, obviously. And you'll see that we kind of peaked at the end of April at 7.5%. And then all of a sudden, we had this nice 0.5% rally through just the first 2 weeks of May. And we're giving a little bit of that back. It's somewhat natural to give some back after you have a big move. But I want to highlight that is actually a good sign that interest rates have rallied. Now, look at the 10-year bond chart. What we're going to see is very similar behavior, right? If we sort of toggle back. So let me zoom out here. So if you see the interest rates, right, popping up, dropping down, popping up, dropping down, they will move with the direction of the 10-year bond, but usually not the same magnitude. So if the 10-year bond all of a sudden drops 0.5%, you don't always see mortgage rates drop that same 0.5%. And I'm going to explain why here to you. One thing that's very important to know, I'm going to go back in time here. And I'm just going to go back to the last Fed tightening cycle because it's going to give you some perspective into this tightening cycle. And in, let's say, late 2016, that was the last normal refinance wave that was not really Fed induced. That one was sort of a combination of the oil crisis that was, when I say crisis, it was great for all of us. It was a deflationary environment where the Saudis were trying to bankrupt the U.S. drillers. Remember, oil went negative for a little period where the U.S. kept drilling and the Saudis went full throttle, and everyone was trying to worry about where they're going to put all this excess oil, and then prices cratered. So there was a period of time where we refinanced. In late 2016, as an industry, we refinanced everyone that bought a home in late 14, all of 15, and early 16. So I want you to think about a bond trader. If you bought a 10-year treasury, you know that investment's good for 10 years. If you bought a mortgage bond, you kind of hope it's good for 7 years. And then all of a sudden, they all refinance in 2.5 years. And you're like, man, that investment didn't work out the way I thought it was going to work out. So then you fast forward, interest rates jump right there, that spike up. That was actually, if I zoom in, that was Trump's election. And that was sort of a pro-growth, inflationary, low taxes, pro-business administration mindset. And obviously that happened. And then the Fed does what the Fed usually does in those environments, which they start raising rates. And then, so everyone then that bought a house in real late 16, but really mostly all of 17, all of 18, all those people refinanced right here in 2019. Coincidentally, it was about the same 10-year bond as it was in 16. So then all these investors came back in the market, started buying bonds again. And all those people wound up getting taken out by the mortgage industry and by consumers who have the ability to refinance all their debt when debt is higher. So then all those investors were like, in this refi wave here, well, we didn't touch any of these loans. So that seems to be kind of like not a generational bottom, but that same bottom was also back in 2012 and 13. So it felt like those bonds were safe and secure. If you buy those mortgages, they're probably going to stick around for a while. And then, of course, you fast forward and then COVID happened. And then every loan in 2019 that refinanced or that was closed in late 19, which happened to be all the loans that also closed in 2017 and 18, all those loans refinanced again in 2020 and then again in 2021. So the reason I tell you all that is when markets are sitting at a high and investors believe that interest rates are likely to go lower, or they're just not sure where they're going to go, they are more likely than not stepping back, and they're just maybe not paying for these mortgages. So the reason I point that out, and I'll give you an example, in late 2020 and 21, when we sold a 3% mortgage rate, we would sell it and we would get 5 points, which seems kind of crazy, right? Almost a year and a half or more of interest, if you just want to put it in that perspective. And then today when we sell a loan and it's at 7%, maybe all in we make 2 points. So why is it that if interest rates are doubled, the amount of money we make as a lender selling loans is cut in half? It's kind of crazy to think, right? Well, the reason is because those investors are kind of like, I don't know, maybe these rates aren't going to stay around very long. Maybe they're just going to refinance. So do I really want to pay up, put that loan on my books, treat it like a real loan if all these loans might refinance, right? So that is sort of a mindset or a behavior that's sort of somewhat pervasive in the trading environment. So all that to say, rates will come down slower. And then once there's conviction and market stability, you generally see more profit come into mortgage companies. That extra profit will push rates even lower, especially for first-time home buyers or anyone that has loan adjustments. So move-up buyers, maybe their credit score is a little bit lower. Maybe you're thinking of buying a second home or an investment property, or you need a second mortgage, or it's a 2-unit, right? All those things that kind of make loans more expensive, it gets easier to absorb those fees. Lenders will begin offering better 0-point loans, where right now 0 points is a little elevated. And if you buy the rate down, sometimes right now in markets like this, 1 point will improve the interest rate 0.5%. So there's an argument that, well, maybe you should pay that 1 point. You get all your money back in 2 years. It's actually not a bad trade. What if inflation is stickier? What if the Fed does have to keep rates higher? It's a pretty good trade. So all that to say, we're probably going to go through a period where it's going to be a little illiquid in the markets, and we just have to take it day by day. It is good news either way that interest rates are dropping. It's also a good sign when investors are not fully paying up for loans that maybe the attitude at the investor level is that rates are going to keep going. So I want to show you a few trends, though, because this is always an interesting way of kind of evaluating markets. So what you'll notice is that interest rates will often trade in these channels. And, a lot of times they just bounce around up and down. And you'll see that some pretty consistent behavior across. I mean, I can just keep drawing these things all day long. Back in the day when I didn't have all these little fancy tools, this goes back like 20 years ago, I had something I called the sticky note analysis. And I would just sort of take these charts and I would take a piece of paper and I would put them on the side like that, right? That line right there. And I would say, oh, that's the channel. That's the edge. If we break that, something is going to happen. And again, we can just keep drawing these all day long, and rates will trade in these channels. And then once they break, once the channel changes, then that path can generally be the exact opposite direction for a meaningful period of time. Okay. So you see we bounced in this channel from May of last year all the way up till October. We broke out. That was like a boom. This was peak fear, confusion. Rates are going to stay high forever. Psych. And then we went back in the channel and then broke it. And then once we broke the channel, that was November, we had a full month and almost 0.75 to 1% rate improvement once we broke that channel. So then we fell into a new channel, bouncing all around. And guess what? We broke the channel. Well, it depends on where you draw it, right? Maybe we could go right there. And we could say that this move we just had reconnected us with the channel. And maybe rates are just going to keep moving up. Maybe. So some people have been drawing the channel kind of more like right like that. And then you could say, ooh, we broke under it and now we popped up. And how do we close today? And how do we trade next week? Do we pop back in that channel? Or does this right here happen? Are we setting yet another new channel where interest rates are, let's say, going to trade like this? So, I don't know what obviously is going to happen. I feel like this right here is what's more likely going to happen. There are reports. There's a macro edge. They track planned layoffs, and they come out with a sort of every time there's a corporate layoff announcement, they throw that on X, and then they add that to their chart. And I think last I checked, we were already on par with some of the earlier months of the year, and we're only halfway through the month. So I do see layoffs actually going up. I did a video where I said that that rates won't actually go meaningfully lower until someone loses their job, and several people lose their job close to you, and then a few months later they can't find a new job. Like that's kind of when there's real stress out there. I don't think we see a lot of that in the DC Baltimore Metro area, but around the country, I think you'll start hearing stories of that. So we don't know. This is TBD, to be determined. I do believe there was an interesting chart. This was posted yesterday. Bank of America, the soft landing scenario is unfolding. We think a 10-year yield declining from 4.35 to 3.25 in the next 6 to 12 months is a good possibility and likely non-consensus. The reason that's important is if you take current mortgage spreads and they think 10-year goes to 3.25, let's add 2.5% or so to that, then you're at a 5.75% mortgage rate. Whereas like right now, if we're averaging 7, it's a 1.25% move lower. Now, again, the question is, what does that mean for if the 10-year drops that significantly? Is that the soft landing drop, or is that an economic crisis drop? Depending on that answer, we'll see what the stock market does. We'll see what that does to the wealth effect, the feeling of people and spending money. And then we'll see how that translates into housing. And then obviously knowing every area is going to be a little bit different in how they feel and experience any economic slowdown that is more likely than not in our future. All right, now let's just look at some real quick housing data. This is the Washington-DC Metro Region Real Estate Report, Altos. I'll put all the links below for the different regions. I'm not going to go over all of them today. It's a lot of the same stuff. We still don't have a lot of inventory. I will say that, people are talking more about year-over-year metrics, where it's like, oh, wow, we have right now 3,800 units in the DC metro area compared to 33. It's a 15 or 16% increase in inventory. That sounds like a crisis, right? Like, wow, inventory is popping. Although I will say this is the first week I've seen at the bottom of all these reports, you'll have sort of a column of new listings and absorbed units, so new contracts. And this is the first time I've actually seen new listings exceed the absorbed in most of the segments of the DC metro area. So definitely something for us to take a look at. All right, so let's dive into some real estate data for the local area. This is the Washington, DC metro area for inventory. And you'll see clearly that 2024 has more inventory, right, than the prior couple years. We have 4,100 units, where this time last year we had 3,400 units. So while that sounds like a big increase, I think it's safe to say we have several million people in our area, and to think that we have 700 or 800 additional units of inventory in our market doesn't quite seem like crisis level, especially when you add 2019 as maybe a pre-pandemic model. We had 10,000 units, so we still have less than half of the inventory, and we could keep going, right? You can go back to add 2017, even less. Back then we had 11,000 units. And again, today we have 4,000. And then we have listings absorbed, which is sort of new homes going under contract for the week. And you'll see we just pulled down a little bit lower. So 650, almost, check that out, identical to last year. So about the same number of houses going on their contract, although we have 800 more units. So what I would normally say is that would be a measure of what we want to keep an eye on. So you have inventory picking up. I would argue that with the stock market taking out a high, with prices rebalancing a little, and with interest rates dropping, I believe that is going to be more of a catalyst. I will say that I'm seeing more of a rush back into cities. So at least for us, the DC and Baltimore city markets have been soft-ish compared to the supporting suburbs, the commuters into the city. I'm actually seeing a lot more energy getting back into the city markets. I think some of that has to do with affordability. For instance, in the DC metro area, if you go into Montgomery County, we kind of need to spend like $1.5 million to get a single family home, same in Northern Virginia, whereas you can go into DC and actually now for $1 million, right, or even 800,000-900,000, you actually start getting a really decent place, right, closer to work. So I think there is going to be a transition that we're going to start seeing there, but that is something for us to definitely keep an eye on. Now let's check the Baltimore market. And here we have their inventory chart, and you can see it is smack dab right on 2022 levels, right? But only, 170 more than where we were last year. So actually in a more of a bind as far as inventory is concerned compared to the DC metro area. If we just go back and add 2019 again as an example, it really shows how much less inventory. They had almost 5,500 units, and we're only at 1,500. So definitely. And one could argue that work from home and the unwinding of work from home, it just made a devastating impact on suburban lifestyles in and around city hubs. I will say that so as far as the Baltimore MSA, that does include Howard County, Maryland. It also includes Anne Arundel County. Now, both of those counties serve both cities. So I have countless people that work in DC that bought in Howard and Anne Arundel. So that is something to think about when we're looking at local housing dynamics and we talk housing shortage and where the spillover really came from. I think luckily in our area, the commute from those areas into the city, it's I mean, it stinks. I do it. It could be anywhere from 50 minutes to an hour and 10-ish, right to the heart of the city from where I live in Annapolis, Maryland, but it's certainly not hateful. As far as new listings, feels very similar. Again, 330 units. It's crazy to think of. Again, we have several million people that live in our market. And here we are talking about only 300 and change new single family units coming on the market. It's absolutely fascinating. And the last thing I'll show you here came from Housing Wire. I put this actually over on my Instagram account. You can always follow me there, Advisor John Downs. What you'll see is the number of months of inventory scattered around every single state. Now, this continues to change, right? Because months of inventory is how many houses are you selling per month? And then what was the active inventory? You can absolutely see where there is stress and where there isn't, right? So if you go to, I like to think that the states that experienced sort of the perception of free living during the pandemic, freer lifestyles, right? The economies were more open than not. I think the energy went there. And I think that energy from a housing perspective, part of it was just people saying, I can go live there. It's cheaper than where I live. Think of the people in California going to like Austin as an example. And my employer's letting me live remotely. So because of all that freedom, you also had the investors that went bananas in the areas, especially with short-term rentals and things like that. So I do believe there's a lot of unwinding of all of that, especially when you then mix in just some stress in the employment market. So if everyone was making more money and everyone had jobs and job layoffs weren't even being discussed right now, and inflation wasn't as crushing as it has been for so many people in our economy, then I think people would be traveling more and more. I'm hearing anecdotally, at least for the Delaware beaches and as well sort of all the way down the coast into Florida, that a lot of the vacation rental premiums per week or per night, that they are all dropping. So this map actually looks like it makes a lot of sense to me. So you have the work from home unwinding of the world, that the explosion of migration and then the retraction of that. It is only logical that it would put some stress into the housing sectors, specifically in those markets. This map to me is not a surprise. It's also not a surprise how I feel in my local market looking at this. I'm in the Maryland and Virginia market, right? 1.1 and 1.2 months supply. I feel that with every contract. Every time a contract goes in, there are other bidders. I have not had a contract where there hasn't been another bidder. There's been some other bidders, sometimes even just circling, but price reductions will come in some segments. Buyers will come in as a result of that. What I'm also seeing is even when things are not competitive, they become competitive. So that is just a thing for people in my market to think about. As an example, let's say a house is listed for $950 and it's on the market for 3 weeks, and the seller brings it down to $900. I'm seeing some of that, specific parts of DC specifically. And then all of a sudden you go in and you're like, it's been on the market and there's no offers. I'm just going to lowball it. Well, what normally happens is someone else has been in that house. That listing agent knows. Maybe that buyer's agent says, hey, this house is like a 7 out of 10. It's not a 10. But if something else comes along, let me know. If my people don't see anything else, they might actually try to bid on this one. And a stale property with a recent price reduction, next thing you know, it becomes competitive. And then it sells almost back to what the original list price was because of the competition. So just know there's a lot of things, a lot of different ways of looking at housing, understanding how it moves, understanding local dynamics, local economy, understanding how interest rates will impact behavior, understanding the wealth effect of the stock market, the wealth effect of family money going downstream to generations. There's a lot of wealth transfer right now. You put all that stuff together, it kind of shapes your local market. For anyone out there looking to buy a house or wanting to have these conversations, this is what I do all day as I counsel people talking about these very specific things, really to just give them confidence in whatever their decision is to do next, right? And sometimes that's wait, sometimes that's buy now, sometimes that's right stronger. everyone's a little bit different depending on where they are in their life and how this house fits into their long-term plans. So if you have any questions, drop them in the comments. You can always reach out. Everyone knows how to follow me. I've got all the links of all the different ways to ping me down below in the description. And I hope you've enjoyed this update. I know it was long-winded. I rambled. I tried to talk a little faster, so hopefully that helped this time. And have a great weekend.